Welcome to Market Radar. We're not investment advisors, security analysts, or brokers. The following information is strictly for entertainment and educational purposes only. None of the information here is intended as a buy or sell recommendation. Welcome to another Market Radar podcast. It's May 15th, 2022. Let's get started with the year-to-date performances. The S&P is down 15.42%. NASDAQ is down 24.11%, Russell down 19.95%, Dow Jones down 11.31%. All indexes are still bearish trend on our model. The regime matrix, we have a combined risk-off percentage of 75.3%, which it keeps creeping up there. It's super high. This is not the regime to be dip buying in right now. And stagflation went up to 41.4%, which we actually looked back, and this is the highest stagflation we've ever had on our model. Highest reading we've had since inception of our model. And deflation, it's also creeping up, but it's not deflation yet, and could be a while since we get deflation based off of how strong this stagflation is. So let's move on to the calendar for next week. On Monday, we've got Treasury International Capital, Empire State Manufacturing Index. Tuesday, we've got retail sales, industrial production, business inventories, housing market index, and Jerome Powell speaking. Wednesday, we have housing starts and permits, EIA petroleum status report. Thursday, we have jobless claims, Philadelphia Fed manufacturing index, existing home sales, EIA natural gas report, and the Fed balance sheet. Friday, we've got no market moving events. So let's take a look at how ES did this past week. So ES kept going down. We did have a little dead cat bounce the last day on Friday. You know, this stagflation regime, it hurts both bulls and bears. So our range, we've got our vamp, upper vamp 43.26. We could realistically see a bounce up to there, squeezing out some shorts. We can even see a move past that up to Momo. That's very possible. So just watch out for that. This is not the regime to be shorting bottoms and getting aggressive. You always want to make sure you're shorting tops or buying dips if you're into that. But no chasing. This is not the regime to be chasing. It's going to hurt both people going long and people going short. So watch out for that. ZN continuing downward. We did have a little bounce this past week. And what's likely going to happen with ZN, it could go further down, but likely outcome, as we've seen during other occasions when in the past, like 2018, 2017, 2014, whenever ZN diverged far away from Momo like this, it tends to chop around for a few months until Momo catches up. And that's likely what we're going to see. Momo is going to slowly creep downward, catch up, and eventually it's going to pivot and start reversing. And it'll be bullish trend because Momo is going to come down because, you know, ZN's not really, it's pretty unlikely we're going to get a straight vertical reversal up to above Momo from here. It's likely going to be, you know, could be 6 months of stagflation, Momo slowly creeping down as ZN chops around, and then our regime model is going to flip deflation, and then ZN is going to go bullish, and when those two align, that's what triggers our play. And we're going to be playing that via TMF, which is triple leveraged TLT. So right now, we've seen people dip buying on Twitter. It's not the time to be doing that right now. You know, we could get a bounce, but it's not going to be the big move, you know. And it's very likely a lot of people are going to be getting burnt buying the dip over here. So watch out for that. We want our models to line up. We may get a deflation trigger and ZN will still be bearish. We're not going to play it. It has to line up. We may nibble on light size, but everything has to line up. So it needs to be bullish trend and a deflation trigger. And it could take months for that to play out. So just need to be patient with that. And yeah, hold cash. We're 50% cash still. That's the play right now. US dollars going up. We're going to talk about that in this podcast. But for now, Gamma, take us away with the interest rates.
So let's talk about what we're going to go over today. So the first thing we're going to go over is the path of interest rates by our friendly Federal Reserve. The next thing we're going to go over is a brief overview of what bonds are and what differentiates them across their term structures, or maturity structures, I should say. And then we're going to have a little watch and learn, and we'll go over that when we get there. So let's start with the federal funds futures. As you can see by the meeting probabilities, we're expected to continuously rise or hike into the end of the year. And if I bring up the Bloomberg snippet of where we should be by the end of the year, December 2022, the implied federal funds rate, it's saying is 2.723%, meaning about 7.5 rate hikes from now, including June's meeting, all the way to December's meeting. The media is portraying the idea of peak inflation. The reason why they're doing this is quite simple, because they need it. Now, and this might sound pretty stupid, but they need the peak inflation narrative. I mean, approval ratings and whatnot, faith in the Fed, all these things are on a steady decline. They always have been with the Federal Reserve. I don't know who really trusts what they do, but they have to always, they're backed into a corner, into their price mandates and the politics, right? So or I should say their mandates of price stability and the politics surrounding the whole inflation narrative. So the government needs peak inflation.
Well, also, inflation is like self-fulfilling prophecy in a way too. So if you can change people's thinking,
right,
that could help as well. So that could be something they're trying to do.
Right, I agree with that. And obviously we have some issues with fertilizer, food. I mean, we've spoken about potential food shortages, I think 4 or 5 podcasts ago, right? We were speaking about the potential there being a food shortage. It hasn't really come to fruition yet, but the whole point is that food prices are still going up, right? Are still very elevated.
Well, India actually just came out and said they're not exporting wheat anymore, right?
Yeah. So that's
could be starting.
Something to watch out for. And we had some people in the Discord talk about that earlier, where they're not sure the direction of how to play this, because we say don't own commodities, right? We're not long commodities because we never want to be in a position where we're fighting the Federal Reserve. Remember, the Federal Reserve is trying to kill inflation. Now, do I think that they're going to kill it right away? No, I don't. I think it's going to lag. I think they're going to have a tough time fighting it, which means commodities should actually do well, or remain elevated and continue to chug higher. Do I think peak inflation is here? I don't know. I would go on the limb and say we have not peaked yet. And we're going to go more into detail on that later. But the way we are positioning for commodities, or I should say, the potential for commodities to rise, is not use equity in our brokerage accounts and accumulate commodities, because it's kind of useless, right? Like if you own SOYB, the soybeans ETF, I mean, you really don't have shit but an equity position in your account. You're better off going out there and buying the non-perishables, getting long physical like foods and resources, just in case if there is some type of short-lived food shortage or any type of issue where commodities continue to skyrocket and they become harder and harder to get, you actually have them and you can use them. And guess what? If you're wrong, the end of the day, you got a couple extra cans of soup, pasta, stuff like that you're going to use anyways. I mean, this is not doomsday prepping. This is just saying, like, if you want to get long commodities, get long the ones that you're going to use. That's really it. But let's go over bonds. We had one person in the Discord really request that we just break this down real quick. And I think that this will help a lot of people. So let's start off by simplifying what a bond is, right? A bond's an agreement between a lender and a borrower over a certain duration for a certain borrowing cost. That borrowing cost is considered the interest rate, right? The interest rate is equivalent to the yield. So if you hear interest rate and you hear yield, they're the same thing. Now, there's a difference between yield to worth, yield to maturity. Those are bond topics, which we won't get into in this podcast. But in the general broad term, interest rate and yield are the same thing. So now the borrower of the bond is being the issuer, right? They're the ones that are borrowing the money. They're issuing the bond. And the lender is the bond purchaser. So the rate of return on a bond is partially set by the market demand and the discretion of auctions. What I mean by that is a company may issue bonds when rates are lower, right? So like a highly leveraged company would love to issue a lot of bonds in a low rate environment because they know if higher rates were to come, they secured financing with at a better cheaper cost overlay on their bottom line. Now, the yield of the bond is your reward for lending the money, right? So that interest rate is your reward for putting out the money. So it's the interest you receive. And now let's simplify the classification of bills, notes, and bonds on the Treasury level. When you hear bonds, they're generally corporate bonds, municipal bonds. Bonds are bonds, right? Bonds are that agreement between a lender and a borrower. That's a bond. But when you go to the Treasury level, you hear these things such as bills, notes, and bonds, and you're not sure what the difference between a note and a bond is. And like, let's first off put aside that they're all bonds. They're all debt, right? They're all an agreement between the lender and a borrower. The borrower being in the treasury market, the United States of America, and the lender being the person that's buying the bond. And the way that they use this terminology of bills, notes, and bonds is just their way of differentiating duration. So what I mean by that is bills, they're bonds that are under or up to a year in maturity. Notes are bonds that are between 1 and 10 years in maturity. And then bonds are bonds that have a maturity greater than 10 years. So in reality, you can see that they're all bonds. They're just notated differently within the Treasury. So if you hear bills, it's really short term. You hear bonds, it's really long term. But they're all bonds at the end of the day, if that makes sense, right? And I think that's important to clarify because a lot of people hear these terms like notes, like a 10-year note, and they're like, well, what's the difference between a 10-year note and a 10-year bond? Well, the 10-year note is the 10-year bond.
Yeah, it's just interchangeable language.
Yeah. It's something that like really is only done at the Treasury level. When you go to corporates, like corporates pretty much it's all bonds, corporate bonds, high yield bonds, junk bonds. They're all the same thing. Investment grade bonds, right? So that's how that works. Now, the core of what we're going to talk about here is what's been trending around on Twitter for a while now, which is this whole watch and learn. What they're referring to, or what that phrase is referring to, is David Hunter, the contrarian, who has been pitching a SPX melt up since January. Or it might have been before, but it really became mainstream in January when he said melt up to SPX like 5,500 or then now 6,000. And the markets have gone in the shitter. So people are basically memeing him. Melt up underway, watch and learn, because that was his response. Everyone was like, well, how are we? They were arguing with him, and his response is watch and learn. Unfortunately, he takes, I think, an inadequate approach when assessing people that are confronting him by blocking them, because it kind of limits the scope of discussion. But he had a podcast that he went over a lot of his viewpoints, and that podcast is going to be linked in the description on the YouTube channel. So you can go there into the description. You can watch that podcast to get an understanding of what we're talking about. So let's unpack what he really talks about and why we understand what he's saying. The watch and learn mentality is kind of arrogant. I don't think it makes sense, but I understand some of his viewpoints of where he's coming from. The first thing that he does say, though, is that he thinks the economy will cause inflation to come down to a 3% CPI by the end of the year. I don't think that's going to happen.
How, like, what's going to cause that?
He's saying that the economy is going to slow, right? So his viewpoint is the economy will basically push the economy will slow, which will bring CPI down. So CPI is going to get dragged down by the economy slowing. I don't
Well,
think he's fact. Oh, go ahead. What were you going to say?
well, I was just going to say the high level, what I understand from what he's saying is he is admitting that the economy is not in a good place,
Right.
that we are on the
Yep.
brink of a recession. Like he
Yep.
said, the definition of a recession is 2 quarters of negative GDP growth,
Right.
and we're already at 1 quarter, right? So
Right.
we're right there. So he's admitting that he thinks what he's saying basically is the Fed is going to intervene and cause the market melt up.
Right.
In
And I
general, that's his theory, right?
Right, right. So what yeah, I think that's a good to like preface the whole thing is that's his theory. His theory is the economy's slowing, the Fed's going to intervene and cause rally. Now we're going to pull apart some of the topics that he talks about, just to give some depth on where we stand with what he's saying. Because again, some of the stuff he says is right. He's not full of bullshit. But I also think the flaw before I get into this is the contrarian viewpoint. Um, you can say whatever you want about contrarians and bulls and bears and consensus positioning. But that's all bullshit, to be honest with you. And that's my opinion. I the reason I have that opinion is because I've seen enough destruction in financial crisis. Specifically, you can look at 2008. It's like a real good example. People weren't sure if they should keep their money in the bank anymore because they weren't after Lehman and Bear Stearns. They weren't sure if their bank was next. So I don't think you can use this idea of like, oh, everyone's scared, so it's time to buy stocks. Now, granted, Warren Buffett's famous saying, which everyone will quote when you say something like that, is, be greedy when everyone's fearful, and be fearful when everyone's greedy. Well, that's okay, but you have to understand the circumstances of why everyone is fearful and why everyone's greedy, right? Is everyone fearful because stocks are going down and the economy is on a dip, or is there like insolvency risk, right? And I think a good way to tie this down is just look at Luna, right? Look at Luna, the cryptocurrency that was trading at like a 20 billion market cap, and now it's going for $6 million or whatever nonsense, right? You can say be fearful when everyone's greedy and be greedy when everyone's fearful, but I can almost guarantee you that if you are greedy right now, you're buying bankruptcy,
Yeah.
right? So it's like you have to understand the circumstances of what you're being greedy and what you're being fearful into. It's kind of like you have to always assess the facts and circumstances, which is why we use a two-factor model, right? Because if we only use the single-factor model, it's very easy to get caught up in the hiccups of time and space where things can be affected and not be in like I should say not be aligned properly because of odd scenarios or out of the ballpark events that don't rhyme with what you're looking at, and you can take those scenarios and extrapolate bullshit data off of and be like, oh, we're good. For example, you can look at something like the economy slowing down and commodities heating up right now, right? Or not heating up, like the economy's slowing down, and this is what goes back to what David, let's wrap this back into what this whole watch and learn is. He's basically saying the economy is going to bring inflation down to 3% CPI by the end of the year. What he's not factoring in to his whole equation is the concept of stagflation, which is exactly the opposite, where the economy can fall, but inflation can remain high. Remember, growth is collapsing or a recession, but inflation can remain higher and trending higher. That is the definition of stagflation, right?
Yeah.
So to say the economy's coming down will cause inflation to come down is only, if you look at our models, is only a fourth of an outcome, right? There's four. There's expansion, inflation, stagflation, deflation. That is deflation. That's only a fourth of a possibility, or I should say, in a falling, in a negative growth environment, it's only half the scenario. The other half is stagflation. If growth is falling, you couldn't get stagflation where inflation remains elevated.
But
And this
like
goes back. Go
even
ahead.
if we do get deflation, so if that's what he's thinking,
hmm
why would that cause a melt up? That would
because
further the drawdown.
well, let's unpack the next thing, right? So he is basically saying we're at peak inflation. So he's betting that peak inflation inflation is going to peak and the market will rally because the Fed will realize they're peaking and they're tightening into deflation. So they're going to go from tightening to easing. So he's basically saying that when we hit deflation, because what he's saying is that the federal funds rates are never, like he said that I think from my memory, he doesn't expect there to be he expects the rate hikes to stop after July, I believe.
And yeah,
So
he also said that negative interest rates are a possibility.
oh
Right?
yeah, that's another thing. Yeah,
Right.
no, his other thing was he thinks that the 10-year is going to go negative in like a year or two.
Okay, so let's
Yeah,
let's organize this. So
yeah,
let's start with just equities, okay? So
right.
let's talk about what his theory is on the melt up. And
Okay,
I believe he said it's going to affect a broad range of equities. It's not going to be isolated. Everything is going to melt up.
right.
That's what he said, right? So,
Yeah, and also I think we need to unpack when we go into this equities is for that equity melt up to happen, or I should say the broad market melt up to happen, you need inflation to peak. Well, not that you need. He's saying that inflation is going to peak, right? He's saying that the highs in bond yields in 10 years in, okay? It's basically in, and we're going to go downwards from here. Expecting the 10-year to go to zero or negative, somewhere in the zero and negative. I don't know the time. I think it's a year, he said. But we're going to attach the video so you can like watch it over and really unpack what he's saying. This is our opinion on what he's saying. So that I think is a problem within itself, because within the same conversation of talking about the 10-year peaking and going down, he's telling us that we're going to he's got a $6 price target on copper. So how does that make sense, right? He also says that the possibility oil has peaked and is going to like $80 to $70 in the next 6 months. And he's saying like gas has peaked too. Well, I think this podcast was recorded the day before the CPI number came out, and on Friday, gas futures hit a new all-time high. So, not to say that oil futures are going to hit. That's not implying oil futures are going to go to an all-time high. That's just saying that I don't think that we were in a position to say that inflation has peaked.
well, so copper going to $6. Let's talk about that. Copper is a little bit of a confusing one because it does
Yeah.
have growth and inflation components in it.
Right, because for example, if you build a house, right, you need copper. Well, this is his other thesis is saying that like the mortgage rates will come down, which will spur home buying again. That home prices have probably, he says home prices have probably topped. They'll come down. They'll spur home buying, and he can buy. You can buy home builders will continue to be active. More pressure will come in, pushing copper higher and lumber higher. Now, if you push copper and lumber higher, I just, especially copper, I don't see how that's I could have a peak inflation stance at the same time. Because copper going up is growth positive, but it's also inflation positive too. That's more like expansion expansion inflation territory, right?
Yeah.
So like you're almost contradicting yourself when you say inflation's peaked.
Yeah. So he's kind of expecting an inflationary regime with positive growth and positive inflation,
But CPI to go down,
but CPI to go down. Which
which
those
makes
Okay,
no
well let's
sense.
talk about why that doesn't make sense. So why doesn't that
Okay.
add up?
Well, if you look at it, he's expecting oil to peak. He thinks oil has peaked, and the only reason that oil went above 100 is because of Ukraine. That's his viewpoint, and he thinks oil is going to go lower. In turn, right? If we know that the energy is a large portion of the consumer price index, this consumer price index should grind lower too, right?
Yep.
In turn, commodities should follow in suit, right? Very rarely does oil, almost never does oil go one way and commodities go the other way.
Yeah. Okay. And so
So
that's deflationary, right?
that's deflationary, right? And his viewpoint is that we're going to get a deflationary regime, right? And once we get a deflationary regime, the Fed is going to realize that 7 rate hikes into the end of the year is too much, and they're going to have to revert their statements, which the market's going to, go back to like the Fed saving the day, right? Easing, right? So the market's going to start melting up because it's been pricing in all these rate hikes. He implies that the bond market has done a lot of the tightening for the Fed, which he's right, it has. That is true, but even with all that tightening, you could say, oh yeah, we peaked inflation. I mean, you're not really seeing any, like, if we look at our regime model, right, we're not seeing deflation odds like really rising substantially yet. So it's like, okay, the Fed, especially, and the Fed has, or I should say, the bond market has been pricing in these rate hikes for months now, and stagflation is still extremely dominant. So it's not as if like the market's already picking up on deflation and it's working. I think that the market's waiting for the Fed to actually act.
Okay. Yeah.
Right? Like the bond market's done one thing, but until the Fed does the other, I don't think you're going to see the breaking commodities. And this also goes back to the commodity situation we spoke about in the previous podcast of there being sticky inflation, right? Because the commodities market, especially with food, right? It's something that everyone needs. It's not something that we can ignore. So there's this demand behind it. And we have this supply chain issue, which the Fed cannot fix directly. So it almost leads us into like an indefinite stagflation, right?
Yeah.
And something else to note about what David is talking about is David's talking about a topping dollar. He thinks the dollar is going to top out, which I personally don't understand how the dollar topping out and going down is like deflationary. That's more of that's like equity risk on, but that's not going to happen, right? Given like if you look at the world from the stance of inflation, it's not just a U.S. domestic thing. This inflation, I mean, you got the BOJ printing basically unlimited funds for yield curve control and unlimited QE, which God bless the Japanese citizens, right? And then you got the euro down at 2017 lows. Like this is not a specific problem in the United States. So even if the Fed pivots, I don't see how it's gonna immediately affect all these other banks are high gung ho and tightening, right? I mean, we went from negative real yields or negative nominal yields on bonds in Germany. We're in positive territory now. Most people never thought we'd get back to positive bond yield territory in Germany. We're back there, right?
Yeah.
Like these are the things that everyone's so complacent, and I think this goes back to the Federal Reserve accommodating markets or accommodating their policies. They can't mask the market, so they can't mask their policies anymore on the market because they have an issue. They have to fight inflation, and they are going to fight inflation. If we look at the CPI, we're mid-range. We're at 8.5, or I guess this hasn't updated for the last reading. We're in the eights still, right? Year over year. This, do I think it's going to 1980s peak? I don't know, honestly. If I knew that, I think I wouldn't be talking to you guys, right? But I think that from what the inflation numbers are telling us and the way the market's acting, I mean, we can just look at something like we'll just look at crude real quick here. Let's see, is it? Well, that's down here. Oh, right here. Sorry, here we go. This is crude. Does this look like something that's peaked? To me, it looks like it's coiling, to be honest.
Kind of looks like it's coiling. Yeah.
Yeah, it kind of looks like it's
going to be
coiling.
heading for new highs.
Yeah,
But I mean, that's
now,
just looking at a chart,
That's just looking at a chart, right? But I mean, here's what do we got? Here's gasoline futures.
Well, that definitely doesn't look like it's peaked.
I know, right? It's obviously made a new high on Friday. Now, I mean, here's diesel, right? I mean, diesel had this blow off, but it's still very elevated. And then like let's look at corn. These are not like, oh my god, they've peaked. Like, what's peaked? Lumber. This I tell you is peaked.
Yeah, but that's more of a growth proxy than
an inflation
proxy, right?
And I think some people don't understand the difference.
Yeah. Okay, so that's David's stance on inflation, essentially. But let's talk about growth. What's his stance on growth? Does he talk about growth?
Not from what I from what I seen. What I see from not from what I've understood. I think he may have briefly spoke about it, but more of what he talks about is that the economy is going to slow and the Fed is going to pivot. That's his main topic. The Fed pivot. The Fed pivot equals market melt up, right? And
So
something that he says in there, I think it's important to note right now because honestly, we have not fucked this up, at least not yet. He goes, I'm confused on why gold and silver are weak since rates stopped rising. Right? He
okay.
doesn't mention anything about real yields. So he's not looking at anything from a real yield perspective. He just says rates have peaked, so gold should go higher. He thinks gold's going to 3K. And he also says gold shouldn't go much lower. I don't think he understands the concept of what the Fed is actually trying to do. And the Fed is going to the Fed wants tighter financial conditions, okay? Because everything's been so loose for so long. They're tightening. They're actively tightening. I think a lot would have to change for them to be like, "Oh my god, we fucked something up."
Well, then
Like
there's also the stance of why front run it
that's my
so
yeah,
by
that's a
like
good
by
point.
such a
That's a good
large
point.
margin. You know,
Yeah.
like
Yeah.
why take a position back in January when he first talked about this? And there's a lot of people that took positions and they're down big now. I see them in his Twitter comments all the time. And if that's your theory that the Fed's going to come in, basically another Fed put, and then you ride the melt up, why front run that?
Right.
You can see it, you can wait for it and wait for the Fed to react and then take your positions. You're not going to be late on the melt up. Why
Right.
be
And that's
so
not
early that you're taking
that's
these
yeah.
drawdowns right now?
That's something that I think is a good point. A lot of people try to front run. You know, one thing that I've learned in all my years of looking at all this stuff and, you know, analyzing what goes on in the interactions between interest rates, gold, and whatnot, and markets, is you can't front run the Fed. You really can't because for so long the Fed was complacent. They didn't do they were lackluster, right? Um, and what David talks about in his podcast, which I actually resonated real well with me, is he goes, the Fed deals with data with reported data, and that reported data is a lag, so they're always going to be behind the curve. And again, he's right. David Hunter is not an idiot. I don't know why people, he's like some people call him a clown, whatever. I think that he has these viewpoints and he takes a contrarian stance, but the way that he analyzes and breaks these problems down, I think gets him into a lot of trouble in the sense that he is positioning himself for the opposite, when in reality, it's not that you should be positioned for the opposite, but you should be positioned for the most likely. And getting a melt up, which is what you saw after COVID. He compares this to, after the Fed intervening in COVID and we had this monster rally. um, we don't have the Federal Reserve. The Federal Reserve can't come out and put their balance sheet from what are we at, 9 trillion to $18 trillion, because that's what they did in COVID. They basically, we went up. I think it was what, like 10, was it like 8 trillion or seven six
Yeah, they
trillion
basically
dollars?
like printed half the money supply at the time.
Right. Well, I think it was like 20% of the floating dollars in the market that we've printed, or something crazy like that, right? So
Yep.
I don't think we're going to do that again. I think it's extremely I think it's almost impossible that we do that again. So the Fed is at a position where they have to fight inflation. Jerome just got appointed, right? He got appointed to his second term, or yeah, I think it's
Yeah.
his second term, and he is now flipping the whole switch, saying 75 basis point rates are possible back on the table. That's what happened. And I think that he's in a very tricky spot in politics wise, because not to get too political, but the Biden administration is being mocked, right? Because of their ideas on how to combat inflation. They think that they can somehow stimulate their way out. And I think the Federal Reserve has the complete opposite stance. They realize that they need to tighten, and um, it's creating such an environment where Powell has to do the thing that no Fed chair wants to do, is he's got to crash the stock market. And I think that he knows that, and he is actively trying to get real yields up. which is why we're long real yields in the grand scheme of things. We're slowly trimming that position, by the way, because we don't have that much time left on the options contracts. We only have till the next Fed meeting, but we're synthetically long real yields by not being long gold, right? I mean, how many macro guys have told you that gold is the play, and gold's gone nowhere but sideways and down? That's because of real yields. Why are real yields rising? Well, the Fed is tightening conditions, and real yields go up in tighter environments. And I think that what David is trying to portray is that all of his ideology comes off as real yields are peaking. That's his thing. That he's basically saying we're going to get a broad market rally, real yields are not gold's going to go up. Remember, gold going up, real yields are going down realistically. So he's saying that if gold's going to 3K, real yields are going down. But I don't think Davey understands what real yields and like the Fed's true intentions are there. I think they, in reality, they're going to try and crush inflation with all they've got, and I think that's the market knows. I think the reason you're having a lackluster of bids and equities is because the market knows that there's no big men in the room holding the world up. That whole that meme where there's the guy holding the world up, and it's like, oh, Apple holding the market up, or whatever it is. One particular thing holding everything together. That's the Fed in the United States equities. And I think that Fed is no longer there, and everyone knows it, which is why we've yet to see a real dominant move higher. Now, not that we can't get one, but I don't think until the inflation landscape changes, we're going to have a reversal in equities. And this goes back to the media saying, oh, peak inflation. Everyone's trying to guess peak inflation because they want to get this trade right. Okay, they want to get the bond trade right. I mean, if you look at bonds, if we look at the 10-year, let's see. The 10-year is gone. I mean, everyone wants to time the top of the 10-year. They're saying oh, we're here, right? We're getting to 2018 peaks. That means that's when the Fed started reversing, right? That's their mind. Oh, peak inflation, the Fed's gone too far. They're never going to get those rate hikes in there. Well, I would like to say inflation's still at 8%. If inflation goes to 7%, if inflation goes to 6%, that's still too high. So what I'd like to say is to the people that peak inflation or the Fed is going to pivot is just watch and learn. Watch and learn what happens with inflation, right? If CPI doesn't peak or stays elevated, right? So if we go, let's look at inflation, right? So the last time the Fed pivoted was back here in 2018. I think it was right here into the end of the year. Right here. Right? They pivoted at 2%. They were like, oh, we got to ease because they realized that they're going to crush the market, right? That's what's going to happen. We're here. A lot of damage has to take place here before the Fed, the Fed's target is they're moving it around, but it's between 2 and 3%. We're at 8, even after the last reading. So There's a lot of the Fed can crank the hikes until we're down. Now, is the Fed going to overcrank it? 100%. That I could agree with anyone. They're going to over tighten. That's going to happen. They're going to over tighten us. They're behind the curve. They're going to do too much when they should have done it earlier. So they're going to oversteer or over tighten, and we're going to that's going to happen. But do I think that David's perspective is that there's going to only be 2 more rate hikes or 2 more not rate hikes, but two more meetings or 3 more meetings of hikes, and then they're not going to be able to complete the year out. I don't know about that. I like to differ. I like to beg to differ on that front because I don't think that the Federal Reserve can pivot that easily, given that again, gasoline futures are not budging. They're making new highs on what the market's pricing in. I mean, oil is not really abating. We'll pull that back up again. If we look at oil, crude oil is not showing signs yet of oh, we're scared. This is showing signs of okay, we're slowing, but we're not it's not really showing signs of a peak. Now, once this goes bearish trend, right, and a lot of these commodities go bearish trend, then we'll be sold on a deflation pivot. But for now, we have to look at it from a perspective of deflation is not. I mean, it's not probable. I mean, it's likely, it's next, but it's not the probable outcome right now. And until it becomes a probable outcome, it's very hard for us to say peak inflation because our models are telling us peak inflation is not the case yet. Could this be peak inflation and it leads into deflation and we get the deflation trigger? Yeah. And then would we have been wrong? Yeah. We'll tell you, okay, it actually was peak inflation. But at the end of the day, we're not going to miss too much of the move if it goes to deflation. You know, understand? You know what I'm saying? Like, okay, inflation peaks today. We roll over to deflation. We're there for the bond trade, or at least
Yeah.
if you know
And
if
there's
the
just
bond
no
trade
point.
aligns.
There's no point in front running it like David's
Hmm.
front running it, because then you're just like you're getting a crazy drawdown. All these people that followed what he's been saying since January are down huge.
Yeah, and they're selling pipe dreams, right? They're like, you know what it is? I think this is the best way to put it. David Hunter is fighting the Fed. He
Yeah,
is.
he's fighting the Fed, and everyone
And
that's buying the dip is buying commodities. They're fighting the Fed because
right,
the sole goal right now is for the Fed to stop inflation.
right. And I think let's talk about this quickly here. This is the average real yield reported by the Fed, by the Federal Reserve every day. Um, it's at 0.26, right? That's where we're at right now. This is as of Friday. I put a chart like this up on Twitter every day. It has it's the Bloomberg chart. This is the Trading View version. They're the same thing. It's just not live. It's delayed by a day. This would be one of the lowest real yields that I can see that we can track back to. I mean, this the reason this doesn't go back past 2010 is there's another there's a newer duration in here. I believe it's the 7 year that doesn't go back that far. But regardless, this will be one of the lowest points in history where the Fed pivots. Last time the Fed pivoted, the Fed pivoted where real yields were all the way up at 1.18. A good way to view this actually is the ANFCI, right? That's our basically our liquidity index, right? This tight flipping here, we're barely into tightening territory. Just look at what has happened in the past. Like 2008 was an extreme tightening. Wow, like just a blowout, right? But even 2001 or 2000, right? Like very elevated. We're just breaching into the subtraction of the subtraction of liquidity. And I mean, the Federal Reserve is going to pivot. We haven't even seen the balance sheet reductions yet, right? Like, um, let's see.
I believe it's
Let's
been
see.
going sideways. They haven't reduced, but they haven't increased either.
Yeah, I'm gonna show you. We're gonna pull it up right now. It's been going sideways. Like we haven't really seen a slide. In 2018, this is what was going on, right? This is where the Fed pivoted, right? They pivoted, then they started back, not QE, whatever that bullshit is. It's probably gonna happen again where they're like not QE, right? This is how these people act. They're what they do. But regardless, this is what the market is realizing is going to happen. This. This is where we are, pretty much, right? We're peak, we're chopping sideways. I don't think the Fed has the luxury of letting the balance sheet stick around like this for that, for this duration. I think we're going to start to see a decline. When that happens, apparently it's supposed to happen in the next meeting or two, right? Um, I don't think that they care if the stock market goes down that much either. At the end of the day, if inflation doesn't abate, like they have to continue doing what they're doing. Now, the stock market going down will effectively enhance deflationary attributes, right? It'll kill any like real demand. But let's go back to the reason why we have demand. We have demand because the supply chains are messed up, right? This is not the same type of demand as if the supply chains were functioning normally and demand just died off. Like we have a problem producing food, right? We have a problem producing oil, getting oil out there. So there's just a limited supply to begin with. So it's not just like, oh, demand fades. Like there is going to be a perpetual amount of demand there because we don't have the supply chains are not in good order. And I think that that's what people are missing. That's where like this stagflation regime goes on a lot longer than most people think because the supply chain issues aren't resolved by the Federal Reserve, nor are they fixed. Um, think of it like this, right? You got a lot of damage done to the markets via inflation, and the Federal Reserve telling you they're going to do something is not enough to fix it. Like what I mean by saying all this in a very layman's terms manner is the Federal Reserve cannot imply they're going to tighten and then the economy tightens.
Yeah, like essentially like the bond market does the tightening for them.
Yeah,
right?
like like you can see that's already happened, right? The bond market's done the tightening,
Yeah,
right? The bond market's been doing the tightening for them since mid last year when it realized that when we got the real stagflation trigger on our system, that's when the bond market started to say like, oh, I mean, realistically, that's when it like bounced up and it really started accelerating down when they was like, oh shit, like this, the Federal Reserve is going to be behind the curve, which everyone knows the Fed's behind the curve always. Like that's just normal. They're a lagging institute, but regardless, the bond have been already tightening. Yet inflation has only started. I mean, it came in higher than expectations, but lower than the previous reading. If you consider that peak inflation, sure, whatever. Regardless, inflation's still above 8%, right? So like it's not showing signs of abating.
no, it's still way too high. And if you just
Yeah,
look at inflationary assets, they're just not abating at all. Crude
right,
oil especially.
right, right. Now, what I mean by abate, like, okay, so I look at this chart and I say, does this look like it's topping? What I mean by that is, does it look like it's peaking? Like, let's say, let's put an example. Like this is peaking, right? You have this excess high, you're going down, you're trending near Momo, and you break lower. Like if we were here, I'd say, oh, there's potential for a peak, right? But we've spent so much time and space in this range here that if we go, like, just think about all the people that are net short peak inflation, net short commodities. The reason we don't short commodities is because it's funny. The Fed is going to crush commodities, so we don't want to long them. But like we the Fed's going to crush commodities, which is why we're not long. We think that they will come down, but we're not sure at the time of which they'll come down because we're still in a bullish commodity regime. So we have no position against commodities. What we said from the beginning of this podcast is instead of getting long physical commodities, we've recommended excuse me, get long equity in your brokerage account, which is just bullshit, right? It's money in a brokerage account. Get long physical commodities. Get long something that pastas, non-perishables. Because if let's just say corn or soybeans and food products and fertilizer continue to rise, you're capitalizing on the fact that you bought them cheap. I'm not telling you to be a doomsday prepper. I'm not telling you to go out there and build a nuclear bunker or any of that crazy shit. I'm just telling you that from a perspective of why long physical commodities when they can't do anything for it? I mean, I keep saying why long commodities in a brokerage account unless you're longing deliverable futures, which again, I mean, you're gonna take delivery of corn bushels? Like, it doesn't make sense. Yeah,
Yeah.
you're better off going to the store and spending that, investing that in
Yeah,
food.
and it's
Um,
it's it's honestly cheap insurance, It's
yeah, and like, guess what? Deflation comes around the corner. All the food prices crash. Are you the schmuck that bought some food that was a little too expensive? Yeah, who cares? I
yeah,
mean,
it's
it doesn't
insurance.
matter. Yeah, but like you're gonna use it anyways, right?
Yeah.
But I mean, diesel in where I live in the Northeast is continuing to rise, and this is pushing gas prices higher because unfortunately, a lot of transportation, we said this in the last video, runs off diesel consuming vehicles. So if diesel continues to go up, prices to transport, shipping, freight, all this stuff goes up. In turn, prices continue to rise. So like it's very hard to get this peak inflation standpoint when the cost of gas just hit an all-time high because remember, gas while diesel is not this obviously they're two different types or two different types of fuel, they're all transportation components, right? So to get from the food from the table to from the farmland to the table requires transportation. And also there's a lag in that process because even if inflation starts to slow, like let's just say fertilizer peaks, right? A lot of that food it doesn't grown overnight, so you can't. It's not you're not getting a high turnover ratio on the fertilizer. You buy fertilizer today, you have food tomorrow, you have to buy fertilizer again. It's a whole it's a whole production year or a whole season of farming. If
Yeah.
fertilizer comes down, I mean, it'll help the continuation of that farm. I mean, obviously you're not using all the fertilizer at once, right? But like those costs are going to be baked in a while until it's going to phase out because again, the food you're getting today wasn't made yesterday, wasn't made a week ago, right? It's everything has to grow. Uh, you have the whole farming process.
Yeah, so
The
bottom line, it's very sticky. It's a very
that's really
sticky and it's also a
yeah,
very self-fulfilling prophecy.
right,
So that's why the Fed really has to step in, and they know that. They're
right.
not they're
Of
not
course
they're
they know
not
that.
dumb. They know that, and they know that you really have to act and crush inflation, and it's going to be painful. I don't think we're going to get a soft landing It's going to be painful,
That's a
but
joke. Yeah,
it's
that's a joke.
something that
But
they have to do, right? Or else,
yeah,
it could get away from them. It like they're always going to be behind. Inflation's going to creep up more. They're going to try to tighten a little bit, but it's not going to be enough. So inflation's going to creep up even more. And then by the end of the day, they're going to have to act way larger and cause a lot more harm because inflation's
right,
going to be way more out of control than it is today.
right. And he's basically what David is talking about in his whole podcast. You can listen to it. We'll link it below, like I said earlier. Is that he is betting on Fed intervention pivoting 180 degrees and going the other way. That doesn't happen unless, in my opinion, that doesn't happen unless CPI gets crushed rather very fast. Like I'm talking the next CPI. I'm talking about we dropped the CPI percent as a whole. The 8.5 or 8% that we're at drops 25% or a quarter at a time. What I mean by that is, we the next reading comes out at 6, and then the next reading comes out at like, you know, at 4.5, and then you know what I'm saying? Like there's a drastic decline. Then the Fed's like, oh shit, we did too much.
Yeah. And also, on top of that, he doesn't really talk about growth. Growth is in the shitter. Like if you look at
Yeah,
IWO,
yeah,
that needs to come back too if you want to get a melt up, you know?
right.
Like you need both growth and inflation for a melt up.
All right,
So
let's look at IWO.
he needs
Here.
he needs that in his favor as well, which the market's forward looking, and look at what the market's pricing in.
Yeah,
It's
the market has yet to see a substantial bounce in growth.
yeah.
To be honest with you.
So
And even if there is one, that's crazy, right? Even if there is one, it could be a bear market rally. You're really in a shit position, right?
yeah.
Like if we have a rally to, let's say, on IWO, the 238s, even 273s, that doesn't mean anything.
No, it's still bearish trend. So there's really no reason to be front running it like he is. You're just going to be taking a massive drawdown for no reason at all when you could just
Yeah.
be sitting and waiting patiently for a proper entry.
What's even crazier is HYG hasn't even shown any signs of life. Thing's been going pretty much straight down. I mean, if we put a line chart, it'll probably look much worse. Yeah, but we'll go back on the candles. This is adjusted for dividends, obviously, right? We're back to like mid-COVID levels, right? This mid-COVID area range. Actually, I should say post-COVID, like coming out of the rally. Like HYG's wiped out almost all of its gains since COVID.
Yeah, essentially, we need a lot of things to do a complete 180 for David to be right. And
Right.
there's just no reason to bet on that, Like the risk to reward just isn't there. Why don't you wait for the setup to properly set up? It's not going to happen overnight. You're going to see things slowly flipping. You're going to see growth slowly increasing. You're going to see inflation, like, crude oil pulling back. When you see that, you can start positioning in. But why front run it?
Yeah,
There's
I
literally
think
no
that's a
reason to
mistake.
front run it
I think
like
that's
he's
a
telling
mistake.
everyone.
Yeah, yeah, I think that's a big mistake that a lot of people are. You know what it is? Is a lot of people want to catch the bottom, and catching the bottom is for bloody hands because your hands are about to get chopped by a bunch of knives. That's really what happens, right? Like you can't catch the bottom, you can't nail the tops. And I think once you start understanding that and you just try to catch the meat of the move of wherever it's possible, you'll realize that you don't need to catch the tops and the bottoms. You don't need to maximize every little point or every little basis point of move in each direction. You're gonna get a better understanding of what's going on and what that does. Instead of chasing bottoms and chasing tops, you have a better understanding of the environment you're in, which gives you more conviction, and you're able to hold through more volatility, giving you like a chance at the bigger piece of the pie over time. And I
Yeah.
think that's what's important.
Yep.
But I think that pretty much wraps it up, right? I mean,
Yeah.
if anyone has any questions, drop it in the Discord. We're gonna put the podcast that he talks about in the description of this YouTube video of this video on YouTube or the podcast on YouTube. And again, David somehow watches this. Like I said, we have no hard feelings towards you. We don't. It's not like we're. This is not meant to pick or insult you. This is just our interpretation of what you are talking about, and maybe it gives you some clarity on what you're looking at. And if we're open for discussion, obviously, if you have any points that we've pointed out that maybe you think are inaccurate. But again, all due respect to everyone in their own opinions. We have our system. He has his consensus, or I should say, contrarian viewpoints, and we each go our own ways. At the end of the day, we're just trying to catch the meat of the moves, and we will see who ends up being right out of all of this. But at the end of the day, this is just one big game, and we live to fight another day.